In this video, I'll walk you through 4 stocks that I believe are attractive right now. These are the companies with strong fundamentals, durable business models, and the ability to keep compounding earnings year after year. Yet, for some reason or another, the market seems to be misunderstanding them or simply not giving them the credit that they deserve. So today, I want to break down what I think the market is getting wrong, why I remain bullish despite their recent share price performance, and what I believe each of these companies is actually worth. So without further ado, let's dive into the first stock on the list, and that is Amazon. Amazon has been one of the most reliable long-term compounders in the market, and yet the stock has barely moved this year. It is only up by about 6% year to date, and even after reporting strong earnings, most of the initial rally has faded away. At first glance, it may seem like the business has lost momentum, but the latest results are telling a different story. In the most recent quarter, Amazon reported revenue of about $180.2 billion, an increase of roughly 12% from a year ago. AWS delivered its fastest growth in more than 2 years, rising by about 20% year over year to $33 billion. Advertising is also expanding at a rapid pace, growing by 24% and is increasingly becoming an important profit driver for the company. So, if the fundamentals look this strong, why has the stock struggled? One major reason is the sharp increase in capital spending. Amazon has been investing heavily in new data centers, AI infrastructure, and automation across its fulfillment network. Because of this investment cycle, its free cash flow in the trailing 12 months fell from about $47.7 billion to roughly $14.8 billion. Not only that, management has also guided that capex will rise further this year and will likely continue increasing in 2026. This has raised concerns among investors because heavy capex means that free cash flow will go down, and there is always uncertainty around whether these investments will eventually pay off. Another concern is that AWS, even though it is growing at a healthy rate, is expanding more slowly than competitors such as Google and Microsoft. However, despite these concerns, Amazon's long-term story remains solid. The company continues to lead online retail in the US, is the global leader in cloud computing through AWS, and is the third largest digital advertiser in the world. Its fulfillment network and robotics capabilities give it a scale and efficiency advantage that is extremely difficult for competitors to replicate. Plus, the company is also pushing deeper into groceries, which could eventually grow to become another powerful subscription driver, much like how Costco uses memberships to drive customer loyalty. As for its AWS slower growth, it isn't actually a major issue. AWS is already the largest cloud provider in the world by a wide margin, so its growth rate would naturally moderate as the base gets larger. What matters more is that AWS still contributes more profits in absolute dollars than most of its competitors, and its market leadership remains intact. So once this capex cycle eventually slows, Amazon free cash flow should rebound strongly. This pattern has repeated many times before. Whenever Amazon enters a heavy investment phase, free cash flow drops temporarily. But once spending normalizes, cash flow tends to recover quickly and often reaches new highs. From a valuation standpoint, Amazon has grown its earnings per share by an average of 27.9% over the past 5 years. So if I apply a slightly lower growth rate of 25%, the stock would still appear undervalued by roughly 10%. In short, while Amazon may not look exciting right now, I still view it as a strong long-term compounder that is well positioned to reward patient shareholders over the years ahead. And if you want a clearer picture of whether a company is worth investing in or not, one great place to start is the Moomoo app. One of my favorites is the company valuation tool, which gives you an instant snapshot of whether a company is potentially cheap or expensive, based on metrics like earnings, cash flow, and historical valuation ranges, thereby helping you avoid overpaying for a company. You can also check analyst ratings, which show not just what Wall Street analysts think, but also provide a breakdown of their reasoning and even their track record. This makes it easier to filter out noise and focus on opinions backed by strong research. Another incredibly useful feature is the Morningstar ratings. Normally, this is a paid service, but Moomoo includes it for free. It is one of the main tools I rely on when evaluating long-term fundamentals. And if you want an extra edge, you can tap into Moomoo AI. It can break down earnings reports, highlight the biggest risks and opportunities, and even answer questions about the company's performance and outlook. New users who sign up to Moomoo SG will get to earn up to $1,315 worth of welcome rewards when you fulfill the terms and conditions, which includes a $60 worth of Nvidia shares. Plus, enjoy zero commission for US, Hong Kong, and Singapore stock trading, as well as zero commission trades on US options every month for up to 100 contracts. Simply follow the steps here and key in my promo code Kelvin88 to get your exclusive reward. For more details of the promotions, do refer to the link promotion page in the description below. Next up, Meta is another company that I believe is currently undervalued, especially when you look at its fundamentals compared to where the stock is trading today. Meta's share price is down by roughly 18% from its recent highs. And the reason for this decline is very similar to Amazon. Meta has been spending aggressively on AI infrastructure, including data centers, custom chips, and advancements in generative AI. These investments are expected to continue rising over the next few years, which has made investors uneasy about its near-term profitability. This uncertainty also comes from the fact that Meta has already gone through a major capex cycle in 2022 and 2023, where it was pouring billions of dollars into building the metaverse. You know, the world of digital avatars with no feet. And now, with another wave of spending coming, investors are concerned that the company might be entering yet another multi-year investment phase that may or may not pay off. However, despite the spending pressure, Meta's latest results show that its core business still remains strong. In its most recent quarter, Meta reported solid revenue growth across its family of apps. User engagement rose across Facebook, Instagram, and WhatsApp, while its advertising business performed well thanks to more accurate AI-driven targeting, higher advertiser demand, and better monetization on Reels. The company currently generates a 25% return on invested capital, which shows that for every dollar invested, Meta is producing solid returns. This gives me confidence that the current AI investment cycle will eventually pay off, a sentiment which Mark Zuckerberg firmly believes in as well. It's also worth remembering that Meta has been here before. Between 2020 and 2022, Meta significantly ramped up spending to build out Reels and its recommendation engine. At the time, these costs were heavily criticized too. Yet today, Reels is one of Meta's fastest growing products and a meaningful driver of both engagement and revenue. So Meta has this track record of investing aggressively early on, only for those investments to strengthen the ecosystem later. And even though reality lapse is still a concern, the picture there has been slowly improving. The Ray-Ban smart glasses has seen encouraging adoption and strong reviews, suggesting that Meta's hardware efforts may not be the cash drain that they once appeared to be. From a valuation standpoint, Meta still looks attractive. If we simply apply its 20% earnings per share growth rate from the past 5 years, the stock would appear undervalued by roughly 8% based on discounted earnings. In short, Meta's recent share price weakness is driven mainly by concerns about rising spending and not by any deterioration in the core business. With strong engagement across its platforms, a powerful advertising engine, and consistent returns on capital, I believe Meta remains well positioned for the long-term growth. Next up, we have MercadoLibre. MercadoLibre is the leading e-commerce and fintech company in Latin America, with its biggest markets being Brazil, Argentina, and Mexico. These are fast-growing but still developing markets where e-commerce penetration and digital payments are far from mature. And even though Amazon has a presence in the region, its footprint is much smaller. In most of these countries, when people think about buying or selling something online, they think of MercadoLibre first. What makes MercadoLibre especially powerful is that it's not just an online marketplace. The company also runs Mercado Pago, one of the largest digital payment and fintech platforms in the region. Mercado Pago handles everything from online checkouts to QR code payments, credit cards, merchant services, and even consumer loans. When combined with its marketplace, this creates a flywheel effect. The more people shop on MercadoLibre, the more transactions flow through Mercado Pago. And the more they use Mercado Pago, the easier it becomes to shop on MercadoLibre. This integration is extremely hard for new entrants to replicate, and it is what gives the company a strong competitive moat. MercadoLibre has fallen by about 20% from its recent all-time highs. But despite that pullback, the company's latest results show that its underlying business remains incredibly strong. In the most recent quarter, total payments volume surged by 40.5% year over year, while gross merchandise volume grew by 27.8%. But what's even more impressive is that MercadoLibre has now reported over 27 consecutive quarters of revenue growth above 30%. For a company this large, that consistency is very rare. Another fast-growing part of the business is advertising. Similar to Amazon, MercadoLibre has used its high-traffic marketplace to build a high-margin advertising platform. In the latest quarter, advertising revenue grew 63% year-over-year. Not only does this improve profitability, it also strengthens the ecosystem by helping sellers drive more visibility and sales. However, with that being said, MercadoLibre operates in a region with unique risks. Latin America is known for its political uncertainty, inflation, and currency volatility, especially in countries like Argentina. These factors can affect the company's performance over the short term. But MercadoLibre has operated in this environment for more than 20 years, and it has repeatedly shown that it can navigate recessions, devaluations, and policy changes. In fact, many of its strongest growth periods occurred during times when the broader economy struggled. Despite these risks, the long-term story remains very compelling. MercadoLibre continues to maintain gross margins around 50% and solid double-digit operating margins. It has built a deep logistics network, a strong brand, and a fintech ecosystem that is growing even faster than its core marketplace. These strengths give the company a multi-decade runway as online shopping, digital payments, and financial inclusion expand across Latin America. As for valuation, analysts currently expect the company to grow EPS by around 30% per year over the next 5 years. But if we take a more conservative estimate of 25%, the stock appears close to its fair value today. This means that any further pullback could provide an attractive entry point for long-term investors. Finally, we have Adobe. Adobe's share price is down by about 26% year to date and is trading roughly 50% below its all-time highs. Much of this decline has come from fears that generative AI tools will disrupt its business model, along with investors' uncertainty about Adobe's ability to monetize its own AI features. But when you take a closer look at the actual business, the fundamentals tell a very different story. Adobe continues to grow its revenue by around 10 to 11% a year, and still generates massive amounts of free cash flow, which has continued to increase over time. On top of that, Adobe operates with nearly 90% gross margins, close to 25% return on capital, and carries very little debt. In fact, the company could pay off all of its debt with just 1 year of free cash flow. And this is where the concerns about AI disruptions start to fall apart. It is estimated that roughly 90% of Adobe's revenue comes from creative and marketing professionals working at major companies. Firms like Disney, Nike, Pepsi, Netflix, and many Fortune 500 creative departments. These are not casual users. These are professionals who require brand consistency, precise control, and the ability to fine-tune every detail of their work, something that pure generative AI tools simply cannot do, at least for now. But more importantly, Adobe is not fighting against AI. It is integrating AI directly into its own products. Features like Generative Fill have already become some of the most used tools in Photoshop, and new capabilities such as Harmonize and custom Firefly models are making creative workflows faster and more efficient rather than replacing creators who are using them. Also, Adobe's ecosystem is incredibly sticky. Once an organization is inside the Adobe suite, it is very hard to leave. Large companies rely on Adobe file formats, Adobe workflows, and Adobe collaboration tools across entire teams. Switching to another platform would require retraining hundreds of employees and disrupting ongoing projects. This creates a powerful moat that AI tools and low-cost alternatives simply cannot break through. Even the major AI players recognize this. Instead of trying to build competing design software, OpenAI and Google have partnered with Adobe to license Firefly models for use inside their ecosystems. This alone shows that even the biggest AI companies see Adobe as the essential software layer for professional creative work. In short, while the market remains fearful, Adobe's core business remains strong, sticky, and deeply embedded across the creative industry. With high margins, rising free cash flow, and deeper AI integration across its platform, Adobe remains one of the more attractive long-term opportunities in the software space. From a valuation standpoint, Adobe also looks attractive. Even if you apply a very conservative estimate and assume the company only grows earnings at 13%, which is its average EPS growth over the past 3 years, the stock still appears to be undervalued by roughly 18%. And if earnings growth returns to its usual mid-teens or high-teens range, the upside will become even more compelling. So those are the 4 stocks that I'm looking at right now, and why I believe they have the potential to deliver strong returns over the long term. As always, make sure to do your own research and invest based on your own risk tolerance. Anyway, hope you found this video useful. Like, share and subscribe as I'll be posting new videos every week.